Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Taiwan index down 0.8%. Hang Seng is up 1%.
Nifty is bounced on Friday from the 61.8% retracement, but not got close on the positive.
Most of that selling that had to take place, that's got absorbed. I'll keep an eye out on that stock.
It's 23,536. It's in the red, as the pre-open was showing.
The idea was to see how can we catapult the brand, to a top 3 position, which is what we aim to do globally.
Our capacity that we've set up is 5,000 a month right now, which is a fairly healthy capacity.
We remain cautious because the real scene on the ground is we are not seeing enough movement at this point in time.
The Nifty and the Sensex trading with cuts of about 0.7 of a percentage point. The Nifty now below 23,400.
Well, President Trump has announced his plans to implement 25% tariffs on steel as well as on aluminium imports.
Now, 50,000 is the mark where we actually break even in EBITDA.
Early morning trades, the rupee went very close to 88, 87, 95.50.
Prime Minister Narendra Modi as he embarks on a 2-day visit to France. Nifty's below 23,350 as it stares at a cut of more than 200 points.
Well, that's the day so far, and you're with us here on Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios, and I have to say it's a pretty sort of easy kind of market to report. Not easy in the sense that it's not light, it's quite heavy, and it's all red. But I mean, it's easy because everything is down. It's that kind of a day. 23,300 around is where the market, the Nifty, is trading at. I'm Prashant. With me, my colleague Surabhi and Reema here. Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Good afternoon, Prashant. I was wondering when you said easy, how? Because for anybody who was hoping for some semblance of stability, and those hopes have been really dashed today. And guys, by the way, we are big underperformers across. I mean, this whole tariff business is affecting everybody. Seems to be hitting us the hardest.
And not to forget rupee, right? It breached the 88 mark against the dollar. From there, it's appreciated a tad bit. I saw 87.6 about 10 minutes back. But that's the headache for foreign investors.
Well, everyone's hoping to hear from President Trump, right? Hopefully he's not as serious about this, and hopefully there's some kind of resolution or some kind of way out. So that's the hope. Everyone's tracking X, tracking to see whether there's any comments that are coming in from there. But clearly, as of today's trading session, Trump's tariffs are weighing on the market.
Absolutely, it's weighing on the stock market. It's weighing on the rupee as well.
Yes.
In a big way. The dollar rupee will come up on your screen. Lata will have more perspective on what's happening there. So we pulled back quite a bit. We were down almost about 50-60 paise, losing about 50-60 paise against the dollar. But there's a sharp recovery, etc., which has happened. I'm not sure if there's any intervention in the market. Lata will be able to sort of shed more light. But let's just look at the equity side. Everything down kind of a day. Declines to advances, the last I checked, is almost 5:1. So five down for every one stock which is higher. Mid and small caps sharply down between 2 and 2.5% on those indices. And of course, I mean, for the Nifty, I'll just put these levels out. Hourly average, etc., everything is gone. Yesterday's low, Friday's lows are gone. So the Nifty 20-day moving average as of last close is 23,300. Let's see if, I mean, we are 50 points away. Let's see if that holds. That's one. And then the 61.8% retracement of the recent bounce from the lows stands at 23,176. I mean, if the 20-day goes, then that is the next number to watch out for. So, I mean, similarly, you can look at the Nifty Bank as well, but just putting out those numbers for the Nifty. But broad amount of pressure and lots of names down with heavy volumes at this point. Reema.
Well, there are just about 8 stocks out of the Nifty 50 in the green right now, and there's only one of them with a gain of more than 1%, and that's Britannia. That's up 1.3%. Other stocks with gains of about 0.6, 0.7 include a Kotak Mahindra Bank, Bharti Airtel. But on the way down, trend continues to get beaten out of shape. It's now down 27% since the year began. Sub 5,200 in terms of a price for Trent. And remember, the 52-week high on this was 8,345. It's a big fall. The Nifty Metal Index is down more than 2.5%. Casualties included Tata Steel, JSW Steel, cuts of 2.5%, 3%. Titan, Power Grid, ONGC, Hero Motor Corp. The cuts are cutting across all the sectors right now. No place to hide. And look at the fall in the mid and the small cap index, 2.5%, 3% gone.
You know, it's a market which is sort of got a very different texture or fabric. And a case in point perhaps is going to be once again the reaction on a PG Electroplast. I mean, this goes back to what we've seen on innumerable companies in this season where numbers are okay. Underlying growth or margins aren't collapsing, but the stock is getting sold off. It's a very different story. PG, we had the management in the morning. Commentary is good. They've upped their guidance for FY25, talking about, newer businesses, helping them, carry the good work forward. The market isn't hearing any of it. Trent, as you guys mentioned as well, continuing to fall out. There's a very, very different market where suddenly the valuation reality is hitting home. But Nigel, I guess that's what they say, right? It's only a slightly mandi ka bazaar where you think about valuations and earnings. Otherwise, it's all about growth.
Well, that's right. And today actually, the lows of today are very, very important because we went down to around the 23,300 odd mark. And that was very, very close to the 20-day MA. So the bulls are looking for, some kind of support level. They have got it. That 23,250 mark becomes very, very important. And just looking at the lows of today, and looking at the texture, I think that, there's a good chance that we see a bit of a pullback and we defend the lows of today, which is 23,300 just for the day. So let's see how that goes. The problem is in the broader markets. Mitesh Thakkar, though, is back with us. Mitesh, what's your view? Y'all have been fairly positive on the index. As of today, what is it? We have pulled back a goodish bit, holding at around the 23,300. And as I mentioned, the 20-day MA at least is holding out for now. Your take?
Good afternoon, Nigel. So, in fact, we had some long positions. We have pruned them down because the stop has been hit. 23,350 was my spot, and actually we did decline below that, though I think we are now trying to claw back and stay above that. But for the timing, at least one trade has been exited. Now, I think the market hasn't turned bearish as yet, so it could be a choppy consolidation. On the downside, I think, 23,200, 150 zone should come into play. And on the upside, now the index needs to get past levels of 23,500 to regain strength. So it could be a 250, 300 point kind of range which could develop. So trade with stock specific bias. For the time being, we've just exited the Nifty long call option spread which we had. But I still believe that we are not starting any kind of a declining move. So it could be a slightly volatile consolidation. On the stock side, the sell on X side, keep a stop at about levels of 377, look for targets of 355. And BEL is another one which is just entering into a slightly negative zone. So sell here with a stop at 279 for targets of 260.
Okay, all right. Mitesh, got it. Thanks very much. By the way, I again checked US futures and European markets as well. There's green. There's green across the board. And in fact, in our neighborhood as well, the markets which are more directly impacted by a lot of this tariff talk, which would be, let's pull up the Hong Kong markets if we can, the way they've closed out. Hong Kong's actually been up 2% today. That's Europe for you. CAC is up, 0.2%. Shanghai markets, mainland markets are up about 0.5% as well. So I was just short point that this is whatever is happening. The pain in the mid-cap market. It's a very India-specific phenomena. Though of course there are the bigger headlines on tariffs and the rupee.
I remember this is of course maybe a couple of years old, and but I suspect it would change too much. There are two countries which are most impacted because this reciprocal tariffs are not new. He's spoken about it during Trump won the first term as well in 2017 onwards. The idea is there should be symmetry, and you charge 10% on my product. Similarly,
we'll charge,
10%. The two countries most with the greatest imbalance in that sense are Thailand and India. I'm not sure how much of this would have been corrected in this budget because they've kind of lowered some duty lines and tariffs, etc. But these are the two countries which have got some of the largest divergences if you just compare, say, US versus its trading partner. So that perhaps at the margin explains why the market here is under a bit more pressure. But as Neelkanth explained, stuff has happened in the budget, and he had that number of $7 to $8 billion worth of exports out of India, which may get impacted, but the number will be reduced now because the government has already taken action and other reasons. So we'll talk more about this. Rupee, of course, is the other one which is also taking a bit of a knock, although it's come off the lows quite a bit. Latha is here to put this in perspective. Latha, over to you.
Well, it was mayhem in the morning because the rupee opened almost at 88, 87.9550 to be precise. Now, it appears that this was not very out of sync with other Asian currencies because some of them did fall about 0.8%. The fall in India at 87.95 would have worked out to about 0.6% fall. And there were ringgit and all had also fallen around the same number. And that's because obviously tariff talk, two kinds of tariff talk. You know, one was reciprocal and the other tariff threat that came was on steel and aluminium. And therefore, obviously, a lot of Asian importers were impacted. But when it opened at that big number, the Reserve Bank appears to have made inquiries whether this is really importers coming in and buying or FPIs buying dollars, and noting that this is more position taking by, you know, what you can call speculators very loosely, but largely banks. They went in and they supported the rupee like hell. People are talking about $2 billion. Some are talking even $3 billion. But it clearly looks like a Reserve Bank support because it vertically fell the dollar from 87.95 all the way to 87.56.57. It has been more or less stable at that level. Now, you stock market guys are lucky. You'll get some 22,800 support and 23,800 resistance. When we try to ask these questions of traders, Forex traders, the level, they themselves tell us the levels we gave you, 87.50 at the beginning of the year, as level that will be reached in March, and 88 by end of the year, are all today, have hit today. So where do you go? At the moment, there's a working figure of 82.25 by March and 89 by December. But who knows? These levels could be just, erased in a day.
Absolutely. No, and actually, Latha, to sort of complete that point, even in equities, when you've got like $2 billion of selling, levels come, levels go. I mean, levels are formed dependent on the force of the flows, right?
Line in the sand.
Yeah, line in the sand in markets like the ones that we're in the midst of. The only hope is, perhaps like Prashant was saying, that the $7 to $8 billion of impact, in a larger scheme of things, look at the Indian GDP. I mean, even if it, there's a trade hit of $7-8 billion with the US, doesn't matter. That's what Nilkant was saying, that we're an inward-looking economy.
But on this issue of extraordinary Indian tariffs, that is only in a few commodities or few items like cars or two-wheelers, Harley Davidson or something like that. The broad swathe of articles is a 10% tariff. Something like some textiles, some cosmetics and some meats are 30%. But when I saw the last import data from the US,
the two items, Latha, which got
there's hardly anything in that.
I think Harley is the biggest point of contention. So if they can resolve that by Valentine's Day.
That is 125
but
and
I think
150.
by value, I saw two things. One is dairy, because we protect our farmers. That is, so that difference is the largest in dairy. Cereals is another one. I mean, these are surprising. Usually we typically talk about...
Usually WTO protects those because that's seen as farmer protection. But then if you don't recognize the WTO, we don't have any...
I think that's why this meeting
but
with...
the broad swathe is actually engineering goods, etc. Our steel is 10%.
Okay, so Valentine's Day, we're all waiting and watching. One thing for sure, which is that one meeting between President Trump and Prime Minister Modi.
Becomes important.
Yeah. Well said. Valentine's Day gift for the markets. But read all over the screen, Dipan Mehta, director at Elixir Equities, is now with us on the show. Dipan, I know you've been cautious in the markets, and I presume you're still more cautious, or now after the kind of price damage, time-wise correction, you're saying that, well, this is enough now. It's got to stop at some point. And then comment on Zaggle Prepaid, 10% down post the margin miss.
So, with every passing day, I'm getting more and more optimistic. And the reason for that is the budget. And I think the budget was excellent. The fact that so much money goes into the hands of the urban consumer does tend to benefit the economy. And then we had a rate cut as well. And there could be further rate cuts going forward as well. So at least something is being done to reverse the slowdown. And the primary reason for our bearishness in the market was the slowdown in the economy, was the slowdown in the earnings. And if some steps are taken to reverse over there, and this particular cycle also of a slowdown, that also will come to an end in a quarter or two. So I think that maybe 2-3% below these levels are good levels to start and actually start putting money to use. No point getting excessively bearish as well. And of course, the wild card is the tariffs on Indian exports. So right now, the strategy has to be to avoid all Indian exporting companies till we don't have a complete grip on where the tariffs are leading. But look, I think there are many stories which may emerge if the consumption cycle picks up. And those are always the interesting ones. They have got great secular growth momentum as well. So with every passing day and every correction, I would like to state that I'm getting a bit more positive and more optimistic.
Now, that's the thing, right? If you got cautious and negative early, you can get positive early also, Deepan, right?
That's a good angle, Prashant. That's a good angle.
No, you have to be. Otherwise, you just got to watch because you're invested. You're just watching it go down, then you're hoping it'll come up because you can't do very much. I mean, unless you're sitting on cash. And for that, you have to have a view early.
Quite some food for thought for me.
No. I mean, I don't know. This is off you in the sense because you did that. And I think that's a good thing. That's a point well taken. No point being excessively bearish. Markets will look ahead. They don't work on what has already happened. You got to look ahead where things will be 3-6 months down the line in that sense. So, any single stocks on your radar, Deepan? Anything looking interesting because we're correcting quite sharply?
I think that looking at the budget, the appliance companies should do well, and all these air conditioning companies last season also, last quarter, they did very well. This year's numbers also are interesting, right from Voltas all the way to Amber, EPAC, Blue Star, even another air cooling company called Symphony. I think these are all the companies which look very interesting to us. And look, it's already warm and we are in February. We're not in March as yet. In February, it's so hot. So we could have a really horrible summer, and that will benefit these companies a hell of a lot. So I'm getting positive on the entire appliance space because more money in the hands of the consumer means more and more of these discretionary spends will go up. I'm not so sure on the FMCG side. And there are lots of stocks on the exporting side, like, the apparel exporter. I thought Coca-Cola's exports numbers were very good. And there are other similar companies as well. PDS reported very good set of numbers, but I'm just waiting to get clarity on these tariffs. There's Pokerna, which is also an export-oriented business, which we like the numbers over there. So I just want to understand how the tariffs play out, but there could be some interesting ideas in India's exporters as well.
By the way, Manisha is just alerting us. Gold is sparkling. Look at this, 2,900 now. That's, I think, spot gold pricing. That's what we're talking about. Gold has gained 10% so far this year. Just so far this year. It's not even like 1.5 months. It's 1 month of January and 10 days of February. And you've got a 10% gain on gold after what was a pretty decent 2024 as well. What a move. It's been absolutely breathtaking on gold. I mean, up 10%. And of course, the Nifty continuing to struggle. By the way, I was looking at mutual funds as well. Though, of course, you're not supposed to look at 6-month returns and 3-month returns, but a lot of people end up doing that. Most funds, including large cap funds, are negative for 6 months. And what's done the best in the last 3 months or so? Gold. Your gold funds, and that's why asset allocation. Going back to, a portfolio management 101 maybe.
Absolutely, and I think it's phenomenal what it's been is done. Let's actually get a banker's perspective as well, right? So the Axis conference kicks off this week, and we have Amitabh Chaudhary, MD and CEO of Axis Bank. I mean, just a growth mood check. Bankers know, what they're seeing in terms of credit offtake across all their segments, and that's essentially what we started by asking him. So just some views here, and we'll come back with Deepan.
Our view is that we have to keep watching the risks quite closely. The credit growth and deposit growth remains muted. RBI has assured during his monetary policy announcement that they will provide durable liquidity, and they do realize that the credit growth does need to pick up for the GDP growth rate to come back to the 6.5–7% range, and that's an important element of that. So hopefully, as RBI takes these measures in the next couple of quarters, we'll see a positive movement. But right now, I mean, while we are optimistic about what could happen, we remain cautious because the real scene on the ground is we are not seeing enough movement at this point in time. As all of us have been pointing out, if the growth slows down, if rupee depreciates, and it has depreciated so rapidly, if global uncertainty remains, tomorrow exports could get impacted, if, let's say, tariffs come in. We cannot say that, by the way, this will not extend to secure forms of business. We are in the risk-taking business. The credit costs are normalizing. We have seen some, obviously stress in some of the sectors. We have to be watchful and cautious that this should not extend to other asset classes also. No, I'm not suggesting that RBI goes slow on some of the measures they have taken. I'm just saying that some of the measures, and individually the measures, have been in some cases so tough and tight. The credit growth has dropped to a level where, obviously you are seeing some signs of stress develop, or it is having an impact on the GDP growth rate. If this same credit growth could go back to 14-15%, it will have a positive reinforcing message in the overall growth rate of the economy, and some of the stress in the system could also go away. I'm not for a minute doubting what RBI has said. I'm just saying we need to wait for those measures to come out and play out, and then hopefully we'll see positive signs. I'm quite optimistic. But the measures RBI has taken on liquidity have been sufficient enough to take care of the deficit in terms of liquidity. They are not led to any surplus liquidity.
Okay, so that's essentially a nice snapshot view from a top banker really there, Amitabh Chaudhary of Axis. Life insurance business data for the month of January came in, and Yash is here. Some really stood out on the positive side, and others were more muted. Yash, take it away.
Well, Prashant, as you rightly pointed out, overall for the industry, the month of January was muted. Both private as well as the total industry premium was in the negative area, but there were select areas of positive news coming in as far as growth is concerned. The first positive news came in for HDFC Life. Strong performance, up 25%. The new business premium in the month of January, 10 months premium is up 13%. January total APE grew by 27%, and retail APE also saw a growth of 25%. ICICI Prudential Life Insurance, it was a modest growth for the company, and that came on a favorable base. January premium growing at 14%, January total AP growing at 24%, and retail AP seeing a growth of about 9%. Axis Max Life Insurance, modest growth on a strong base which the company had to work on. January premium grew by 9%, total AP 12%, and January retail AP grew by about 14%. SBI Life Insurance, it was a weak growth, but do remember the company had a very strong base to work on. January premium was down 37%. January total AP grew by just about 3%. January retail AP grew by 18%. Finally, LIC, again, weak growth. It's been continuous that way for LIC, but it had a strong base to work on in the month of January. So the total premium was down 14%, total AP was down 27%. Finally, retail AP also saw a contraction of 7%.
Okay, all right. Thanks a lot for that, Yash. Well, let's go back to Deepan. Deepan, anything you like from the space, insurance space?
Yeah, HDFC Life, the best insurance company to buy, and markets like these, you want safety, you want stability. It's a great stock to buy. But the cheapest, I still believe, is LIC, and that also can give very good returns. And the beauty of the insurance industry, if you look at the numbers, is that we are always valuing them on a price to embedded value business. And most of the private insurance companies, the embedded value led by HDFC Life is easily growing at that low 20% or so. So if you assume that that particular valuation multiple remains constant, these companies can easily deliver 15-16% compounded growth, which is very good in a market like this. So I think it's one sector you should definitely get overweight in. LIC, usual disclosure, we and our clients are invested. There's only the expectation that the valuation multiple may improve over here and may start to trade at least at its embedded value. Right now, it's going at a discount.
Okay, all right, got it. Deepan, thank you very much for the call and the view. We do have to take a very quick break at this point in time. Come back on the other side, and we'll have more conversations lined up. Jigar Mistry is going to be joining in, and we'll discuss some of the key movers and shakers of the day.
Welcome back. 175 points down on the Nifty, 23,390. And there's about a 30-odd point recovery which is emerging as we speak. Jigar Mistry is with us, co-founder, Buoyant Capital. Jigar, good to have you back on the program. I mean, I remember your views last couple of times. You've been cautious. You've been cautious for a while. And I think it's working out well. If you're sitting on cash, as Deepan has been, what's the view? Deepan was earlier telling us that, I mean, no reason to be excessively bearish now. You've got to start to have an open mind and maybe at least scout, if not press the button. But just your thoughts on what you're seeing.
Hi, Prashant. Yes, I think, see, what's transpiring is that if you take a 5 or a 10-year rolling return on any index of your choice or any stock with a long enough trading history, the free cash flow and the share prices or the index prices have always aligned with a sort of a percentage or two here or there. Those two have always followed in complete sync. This is on a rolling return basis. However, when I looked at, say, about a month and a half back when we last spoke, the sort of 3-year CAGR on the large cap was a percentage or a 2 percentage points difference. But small caps earnings growth was something like 14% and the share price growth was 26% CAGR. So there was an embedded 12% CAGR overvaluation that was built into small caps in general. This needs to unwind because if over a 5 or a 10-year rolling return, the two numbers always coincide, then essentially you must be able to argue that the earnings growth will be way above trajectory, and failing which the share prices have to correct. Today, or at least at that point in time, and even today, we were not in a position to argue that the earnings growth will be materially higher than what the trend numbers have been, and therefore it stands to reason that the share prices needed to correct. Now, there are 2 or 3 ways in which it could play out. One, the stock share prices go flat for 2 years and the earnings grows 10% each, and then that corrects the anomaly. Or sort of the index corrects 10% and the earnings rise 10% over a year, and that corrects the anomaly. Or worst case, today stock prices fall 20% and the earnings don't really change, and that corrects the anomaly. So I think we would somewhere be in the sort of second or the third trajectory where, given that retail has been driving a lot of this embedded value creation, it would be reasonably swift. We had moved predominantly into large caps over the last few months, and we will be looking at opportunities over the next few months on where we can increase exposure into a lot of these otherwise interesting companies.
Jigar, hi, afternoon. You've not been a big proponent or fan of taking cash calls. Instead, your approach has been adjust the beta of your portfolio in order to ride out all the cycles, the down cycle that we've been in. So tell us how your portfolio is constructed right now and incremental adjustments that you're making. Take us through the view there.
Right, Rima. So, if I give you a statistic to start, if you were in the markets since the early 2000s, you would have been exposed to something like 6,000 trading days, and your returns would have been around 17 times or thereabouts. Of those 6,000 trading days, 10 days, 0.2% of the days have accounted for 60% of the returns. And we have all heard of power laws, 80-20, or if you are in venture capital, then maybe 99-1%. But we haven't really seen a power law where 0.6% of the days, 0.2% of the days, account for 60% of your returns. 25 days, which is 0.4% of the days, account for 84% of your returns. Obviously, there can't be a strategy to identify these days, right? These days, and you can just get positioned accordingly. In absence of which, creating very large cash calls is counterproductive, because if you miss out on a few of those days, then you end up generating sort of extremely low returns. And therefore, what we end up following is getting into small and mid caps when the markets get very, very sort of pessimistic. So peak of COVID, when everybody else was buying IT, pharma, FMCG, that's where our small and mid cap positioning was almost 65% of the portfolio. By September 21, we had started reducing that. By the time Russia-Ukraine happened, we were even Stevens. Similarly, in May 23, we were again 65% of small and mid caps. And today, as of end of January, we have 52% large caps and a much smaller exposure into smaller caps. Within sectors, I think we have debated this in the past. If I look at the same earnings versus the share price dislocation, then financials, healthcare, discretionary, and real estate sort of stand out. Materials as well, sorry. Real estate is one sector that we don't understand all that well, but a large part of our sort of portfolio is positioned therein.
Okay, all right. Hi, Jigar. Good afternoon. And I think you know the sector I'm going to ask you about. What do you do with the metals pack? Trump's tariff seems to have ruffled feathers today at least. And the stocks are very, very nervous. But we've seen in the past that sometimes these stocks recover. And I think for the ferrous industry, the bigger point is, will there be some protection that will come in? And could these tariffs now actually make their case even stronger? How do you approach the space?
Right, Nigel. So I think in an era where the value of the dollar is being propped up by measures that are driven by the executive, then sort of as a commodity metal sort of start taking the brunt as it is. In the event where you put up artificial barriers to trade, and in this scenario, I don't even think they were, like for example, Mexico and Canada, this was supposed to come into effect on 4th, and suddenly on 3rd, they completely changed everything. In this case, I think they're sort of taking a very broad brush and, trying to apply it to a broad sector of commodities. And therefore, in an environment where dollar is appreciating, commodities as it is don't do well, and then you add to this the tariff troubles, it exacerbates the situation. So my sense is that, okay, if all of this were to play out, then you will see a situation where these companies don't do well. But as you mentioned, these are counterbalancing effects. So, if you do something, I'll do something else. And eventually all of us will end up generating a higher inflation for both of our countries. Hopefully when the leaders meet, I think it's later in this week, I think these situations could get thrashed out in a better fashion. But otherwise, it's a lose-lose for everybody. And India's trade surplus last year was something like $32 billion overall. FDI until last year was positive, although net FDI now is getting into a little negative trajectory. So a broad brush sort of thing with India, I don't think really sort of matters as much as sort of with a few other countries who are carrying one-sided deficits with the US matter. But I think this should work out over the next few weeks as we see it.
Okay. All right, Jigar, thank you very much for that. Shorter conversation today, but thank you for the perspective. Just a quick check before we head across to Nimesh and Nigel on the other side. Mid-cap index is trying to recover a little bit, still down 2% or so. The advanced decline ratio, that continues to be quite negative. Let's just pull up the advanced declines. You still have over 2,100 stocks on the declining side, and advances are less than 500. That kind of a day. Not much respite, but let's head back to Nigel, and I think he's got Nimesh with him. What's the mood like out there?
Well, that's right. Let's go across to Nimesh straight away. Nimesh, what are you picking up? Today's a bit of a down day, though if you have to say in the last 30 minutes or so, we've seen some kind of recovery from the lows. What's the flows picture? How are things looking?
Well, in a flow from a large index point of view, it's not very bad. So, okay. And that's maybe showing up in the Nifty as well. The bigger pain is in the broader market names, and a lot of individual stocks are down. The breadth is quite weak as well. The indices are down 2-3%, so that shows the kind of nervousness which is there. And I guess, I was listening to the guest as well. I guess what is happening, Nigel, in the broader market is a reset of multiples.
Yes.
That's clearly the point now. Anything which is expensive and not delivered on numbers is something which is getting heavily punished. I was looking at the BSE 500 data. In the BSE 500, from the 52-week high, only 4 stocks are in the green, or 3 or 4 stocks are in the green. Almost 490 stocks are giving negative returns from the 50-week high. So that's the kind of damage we've seen in the broader market names just in the last 2 or 3 months, right? I mean, from 50-week high, we're down sharply from those levels. So that's clearly the broader market picture. As I said, in the large caps, the flows are largely driven on the negative side in the financial. So surprisingly, a lot of private bank is where there is a bit of selling pressure, and to counter it, there is a bit of buying in the IT names. So which is I'm saying, there's no big selling in the large cap names or the broader market in the bigger stocks, so to speak. From the larger FIs today. Technically, 23,300 is a level to watch. If that gets taken out on the downside, then the next level to watch will be 22,800, 22,900. So, need to see whether we manage to hold on to 23,300. But I guess even that gets managed. The bigger challenge is the sharp fall of the supply in the broader market names.
That's right. Nimesh, just one stock that's standing out for the last couple of trading sessions is Kotak Mahindra Bank. The Nifty, as you said, is under pressure. The Nifty Bank as well is down close to 200 points. But Kotak Mahindra Bank is at the high point of the day. So I think the street is, hoping for a couple of things to move in their favor. But what about other stocks? What are you tracking?
So in terms of individual names, the first stock on my list today is Wipro. Within the IT stocks, this is relatively outperformed. And even in the overall scheme of things, Wipro has stood out today and actually in the green, largely because there is aggressive buying from the larger FIs. So overall, I guess there is buying in the IT pack. And Wipro stands out in terms of very aggressive buying today. So that's the first name. The second stock is Tata Motors. It has almost corrected 30-35% from the peaks. And there has been selling pressure as well. But off late, some bit of buying has emerged. There are buy flows at FIDs today. And interestingly, I understand a couple of large HNI investors also have started turning bullish on Tata Motors at these levels. So that's the second name. The third name is Aegis Logistics. Even that stock has corrected sharply from the recent highs, down in today's market as well. I understand there is a large FIB holder who is a big seller in that particular stock. And at the same time, some HNIs have bought as well. But largely, there is supply from larger FIs, which is putting pressure on Aegis Logistics. And the last is Cummins India. That stock is actually outperforming today's market. There were buy flows as well, and additionally, a couple of upgrades as well from the likes of Kotak. So maybe that's the reason why Cummins has actually outperformed in today's weak market.
Thank you very much for that interesting list. As always, there has been a little bit of a recovery in the markets. The Nifty Bank 2 is now down only about 300 points. At the session low, it was down more than 500, 600 points. Get into a break. We'll come back with more BTST calls from our technical experts. Stay tuned.
Okay, welcome back. So what we have is some semblance of stability. At least the fall hasn't deepened in the while that we've been on closing bell. So that's the good news. Some attempt at a recovery. Let's go back to Mitesh to understand what the levels are looking like and what trades you can still consider. Mitesh, let's quickly revisit. Considering today's price action, Nifty, Bank Nifty, what's the advice? And any more individual stock trades?
No, see, as I said, it's not looking a market which will fall. So while we've come below the pivot levels and the trade stop loss could be triggered on the long side, I expect some sideways consolidation. With that, I have a BTST in Bharti. Keep a stop at 1684, look for targets of 1710, and Crompton is something, which is turning slightly negative. So STBT here with a stop at 352 half and a target of 345.
Thank you very much for that. Anand Tandon, market expert, is now with us for the last 15 minutes of today's trading session. Anand, so many stocks have fallen 20, 30% in a span of what? Since the beginning of the year. Have you been, according to you, where is the opportunity and have you made any purchases?
Like most people have been arguing, the valuation in the mid cap and small cap, largely the small cap still remains fairly challenging, given the kind of earnings growth that we have been witnessing and the valuation where they are compared to both their historic past as well as relative to the larger cap. So the value, if at all, is emerging in the large cap. In the large cap, obviously, companies which have done reasonably well, for example, are companies like Mahindra and Mahindra, Bharti, etc., which I think one could argue that will continue to show fairly stable kind of growth rates even going forward from here. And therefore, those are the areas that one should be looking at in a market which is fairly volatile otherwise.
Okay, I just want to, Anand, hi, good afternoon. We spoke with Anish Shah of Mahindra and Mahindra. I just want to, for our viewers, play out that soundbite again. So third quarter was pretty good. Fourth quarter, on the tractor side especially, there is more visibility. They're guiding for 15% plus growth in the tractor segment. We spoke about, safeguard duties, the price of steel rises, what that will do for tractors, and of course, other sort of stuff as well. So lots there. The EV bookings open on the 14th of February. Here's Anish Shah.
Margins will be slightly lower to start with because you would expect that with a new product, also because it's electric. And we will be showing margins separately for ICE versus electric. And over time, they will catch up because that's where the investments come in for. And we would expect margins to be similar to ICE in the longer run, but it will take us time for us to get there. Our target, and we have been fairly audacious in what we do, is to get to 40% in every segment we play in. So yes, we have a while to go, but that is part of the journey. So we do see a lot of green shoots in rural, as we've talked about earlier as well. Yes. For the fourth quarter, we expect 15% growth year over year. and that's a very healthy growth in this space. For next year, a little early to say as yet, because it will depend on this particular season and how that goes as well. But overall, we remain fairly optimistic about where rural is right now and prospects for attractive business next year.
No, that's a decent sort of comment and commentary coming in there. Now, another stock is Tilaknagar Industries, which is down 20%. And there's a negative news flow here. There's a bit of a setback. Mangalam is here with more details. Mangalam.
Well, so the company had actually sought an injunction against allied blenders from manufacturing, bottling or selling alcohol products bearing the trademark Mansion House and Savoy Club. Remember, Mansion House is one of the stronger brands of Tilaknagar Industries, under which they sell not only whiskey, brandy, but also flavored brandy. So it's one of those, hallmark brands of the company. But the Bombay High Court has dismissed the company's plea in this trademark dispute. And by doing so, what in effect it has done is allowed allied blenders, to bear the Mansion House brand for some of the products that they will sell in West Bengal. To its part, the company has gone ahead and said that this order will not come into effect for the next 4 weeks. And during this period, ABD cannot introduce any new product with the trademark Mansion House. And while that happens, the company will go ahead and make an appeal against this order made by the Bombay High Court itself. So those are a couple of, legal uncertainties that the street is battling with. These are legal uncertainties. Are there any financial uncertainties? To that, the company says no, because status quo remains on them using the brand Mansion House. And at the same time, they do not expect any financial implication of this in the business. But from a business standpoint, if your competitor has a similar brand name and there is no legal recourse against that, then that could cause a lot of confusion in the marketplace. But as this battle draws out and there are appeals, etc., we'll keep an eye out on the story as this develops. As of now, no financial implication, and the brand Mansion House continues to stay with Tilaknagar Industries. But what happens from here on and whether others are allowed to use that brand itself or not is something that we'll most definitely watch out for.
Okay, all right, got it. That's Tilaknagar Industries, obviously 20% down circuit on the implications of what this could mean. Thanks, Mangalam, for that. Numbers are coming through for PNC Infra. Now, you might be wondering, why is the stock up in green, considering that performance that's flashing on the screen? That's because of a different reason. This company had been singled out by NHAI and it had been disqualified from bidding for, I think, over a year initially. Now that period of disqualification has been reduced, and I think it's only 4 months now. So, I mean, the extent of the punishment has been limited or reduced, given the the conversations involved, and I guess that's why the stock's been holding up. Numbers, obviously, it's been a trying quarter, it seems like, for them. We've got Anand Tandon, of course, still with us. Anand, on Alcobev stocks, I'm not sure if you look at Tilaknagar in any detail or not, but if not Tilaknagar, anything else on Alcobev? Because some of the companies have been weathering the storm quite well, including whatever's been happening in Telangana.
Well, yes, I think, the sector as a whole, several companies have performed reasonably well. And, I think the standout perhaps would be something like a Radico, which has over several years actually been improving their performance. I think it remains one of the more attractive stocks, not in terms of valuation, but in terms of where they are headed from a business perspective. What is happening in Telangana is not unique. It is something that keeps happening because most states do control their distribution. And depending on their own financial stress, they will end up, trying to change things around. I would imagine that those are somewhat, transient, because this is one of the largest areas of state revenue. And, when you have a popular brand trying to stay away, then obviously the government is also forced to take some corrective measures. So, there may be small disruptions near term, but I think overall, those are not going to be material for the companies in the longer term. What are more material are things like what you just mentioned for Tilaknagar, where, the competitive landscape itself changes because of legal orders. That can certainly set the company back quite a bit.
Anand, do stay on. Need to slip into a very short break. Before that, let's get you the Growth Code, which is an initiative by Grow and CNBC-TV18 designed to equip you with valuable trading strategies. And as we conclude this special initiative, Prashant sat down with SEBI's whole-time member, Mr. Anand Narayan, to discuss the significance of asset allocation.
We talk about equities, we talk about F&O, but there's also asset allocation at a broader level, right? When you pull back and look at what you should be really doing, whether you should be buying A stock or B stock or C stock. Well, is that the right question to ask, or is an important question to ask? I mean, where are you invested? What asset classes? How important is that to your mind?
So Prashant, as a former academic, let me quote a few papers. So 1986, there was this seminal paper by Brinson, Hood and Biebauer, which actually went on to show that a predominant portion of the variance in returns across portfolios is explained because of asset allocation. Less than 10% was explained by stock selection or by timing the market. What that means in English is the following. As an individual investor looking for the long-term investment and being a responsible investor, you should be spending a lot of time in figuring out what your risk appetite is, the first question that we sought. And then based on your risk appetite, you have to create a portfolio, a diversified portfolio, which mirrors that risk return across all asset classes. You know, you've got to have equity, you've got to have debt, you've got to have real estate, commodities, fixed income, all of that put together, right? So you create that portfolio based on your risk appetite. Once you decide your asset allocation, that pretty much will determine 90% of the variation of the returns going forward. Some of our investors tend to spend an inordinate amount of time on picking stocks or on timing the market.
99% of the investors.
That's right. So it's a bit of a Pareto principle where we spend inordinate amount of time on something that matters very little. And we don't spend enough time on what really matters, which is doing a thoughtful asset allocation.
Welcome back. Well, the stock that's clearly got some current right now is Kotak Mahindra Bank. Remember, over the last 5 years or so, the stock has not even gone up more than 22%, I think so. But in the last couple of days, the stock has done quite well. And if I look at it, in the last month or so, the stock is up 10%. Anand is still with us. Anand, what do you make of Kotak Mahindra Bank? If we're talking about valuations not going out of whack, this is one private sector bank that actually valuations are at a similar level in comparison to even COVID lows. What's your take on this one?
That is true, and I think that makes it a very interesting stock to look at. It has multiple businesses which are all largely well run besides the bank. So therefore, from that perspective also, its investment holding values will be reasonable. And as you said, it hasn't moved at all. Its deposit capabilities are fairly strong. So the key point at this time, I think, for banks would be the ability to raise their liabilities. And that is something that Kotak does very well. Broadly, I think, it is certainly something that one should be examining closely.
Okay, got that. That's on the banking side. Let's take a look at some more stocks. And Trent obviously has been the classic whipping boy of this market consolidation or correction, call it what you want. Anand, let's take this up then. Trent is now down how much? It's down almost 40% from its peak. Used to be an 8,000 rupee stock. A lot of people who are holding it are wondering whether they should get out, watching the decimation. Those who've not had it but have heard those fables and big stories are wondering if this is a good time to get in. What would your advice be on such high-flying stocks, richly valued stocks?
Well, it's one of the best-run companies around, but the point is that every company finally hits a level where it starts to get competition. And Trent, the competition is coming at Zudio and things like that, which is one of their biggest growth and earnings drivers. There are others which have actually now put up products in the same price points and who are also expanding. So obviously there is going to be some pressure on margin, and with that pressure coming through, it is not surprising that you are seeing that kind of reaction. Now, obviously, anything which is as richly valued as Trent, when it falls, will fall fairly sharply. But I don't know whether this is the right time to be getting into it because there is no particular trigger right now. But, it is certainly a stock which, if you want to be in the space, it's probably one of the best run companies around. If you are looking at near-term triggers, you have to be looking more at consumer durables kind of things, because those are the places where, your immediate impact on the budgetary provisions that we saw a week ago are likely to make an immediate dent in terms of demand increase. At least that's what one hopes for.
By the way, is there Anand, hi, good afternoon. Is there a barbecue nation around you where you stay, Anand?
There is indeed.
Have you been to one lately?
Not for a long time.
Okay. When the stock has come off sharply, Anand, high was 2,000. Forget high. I mean, no need to get anchored to the high. But it's come down. It's about 300 bucks, 1,200 crore market cap. I was just looked at numbers, annual numbers. I mean, again, numbers are nothing great in that sense. Top line has been flat for a few years now. 23, 20. I mean, actually, 24 over 23, no growth. Maybe 25 over 24, minor growth. At a net level, I think there was a loss last 2 years. Any thoughts at all? Barbecue Nation.
So for most restaurants, it is very difficult to keep the excitement up because at the end of the day, the product tends to lag. I mean, you get used to it and after a while, it is no more as attractive. There is a new kid in town which you want to go. And the need for refurbishment of your older facilities becomes fairly good, especially if you are a sit-down dining kind of thing like Barbecue Nation is. So overall, your cost of operations is quite high. Keeping product excitement is fairly difficult. And that is why you see, the QSR formats which do well are the takeaway kind of dominated businesses, not so much the sit down and eat in the place kind of areas. So it's going to be difficult always to keep trying to refresh your produce as well as the excitement around it for the market to come in. More importantly, if you don't grow new spaces, obviously your top line becomes stagnant. I think Barbecue Nation is suffering from all of those symptoms right now. The management clearly has some thinking to do. I mean, it's not something that is going to be very easy. The product remains attractive, but whether or not somebody will want to keep going to that place for the same kind of cuisine is a bit of a question.
Okay, Anand, stay with us. I'm just going to quickly wrap out markets here. So the Nifty will end not at the day's low, but not a bit of a bounce. The absolute lows made at about 23,316. 23,377. The 20 days at 23,300 as of yesterday, as of Friday's close. So that holds for now. And the Nifty Bank, of course, did start to turn, starting about 224 in the afternoon. When we actually pretty much started, that's when the market made a bit of a low. We were at, I think, about 49,820. And we are at about 49,980. By close. So there was a bit of a lift which the Nifty Bank saw in the last 1 hour or so, but 2% cuts in the mid and the small cap part of the market. And that's essentially the real issue. 5:1 declines to advances. Actually 4:1 now. 600 lower, 600 higher and about 2,200 lower by close. That's the advanced decline ratio as far as NSE stocks are concerned.
Yeah, absolutely. In a weekday for mid caps, a long list of losers actually. Just very quickly to take some names, JM Financial 7.5% down, NetWeb 8% down, Zaggle 10% down, Tilak Nagar, of course, we discussed the developments there, 20% down over there, Boros, so it's a long list really out there of stocks that have been fairly weak today. That's where we'll wrap up this edition of Closing Bell, but all the commentary and the analysis on today's market fall continues. Up next is Markets Forward.